Smart money concepts, also known as SMC. What is that? It's something that's very confusing to a lot of people. So here's what I'm gonna do. I'm gonna explain everything you need to know about SMCs. Before we touch the chart, let's begin with understanding what smart money concepts actually mean. SMC is a way of reading price based on how the larger players may be positioning themselves in the market. Instead of only looking at trend lines, candlesticks, and indicators, smart money concepts focuses on liquidity, structure, supply, demand, and the areas where traders are likely to get trapped. So in simple terms, SMC tries to answer one simple question. Where is price most likely to go next to collect liquidity, shift structure, and continue moving? The reason this matters is because the markets need liquidity to move. For every buyer, there is a seller. For every seller, there must be a buyer. So when large players want to enter or exit the position, they need enough orders from the other side. That's why price often moves into obvious lows, obvious highs, support, resistance, and breakout zones. Because that's usually where retail traders place orders and stop losses. This is why in SMC, we don't see support and resistance as just lines. We see them as areas where liquidity is building. Now let's break down the main SMC terms. Liquidity is basically where orders are sitting. If a lot of traders buy at support, their stop losses usually sit below that support. That area becomes sell-side liquidity. If a lot of traders sell at resistance, their stops usually sit above resistance. That area becomes buy-side liquidity. Price often moves toward these areas because that's where orders are available. A liquidity sweep happens when price pushes above a high or below a low, triggers those orders, and then reverses. To beginners, this looks like a fake out. In SMC, it can be a sign that price collected liquidity before moving in the opposite direction. Market structure. Market structure is the direction price is moving. If price is making higher highs and higher lows, structure is bullish. If price is making lower lows and lower highs, structure is bearish. SMC uses structure to understand who is currently in control. BOS, or break of structure, means price breaks a meaningful previous high or low and confirms continuation in that direction. A bullish BOS means buyers are continuing control. A bearish BOS means sellers are continuing control. Change of character is usually the first sign that market behavior may be changing. For example, if price has been bearish and then suddenly breaks a previous lower high, that can suggest sellers are weakening and buyers may step in. Supply zones. Supply zones are areas where strong selling previously entered the market and pushed price down aggressively. They usually form right before a sharp move lower, and they tell you that sellers were in control at that point. Demand zones are the opposite. These are areas where strong buying came into the market and pushed price up aggressively. They form right before a strong move higher, showing that buyers were in control there. Order blocks. Order blocks are specific zones where a strong move may have originated. A bullish order block is usually the last bearish candle or consolidation before a strong move up. A bearish order block is usually the last bullish candle or consolidation before a strong move down. Fair value gaps, or FVGs, are imbalanced areas created where price moves too quickly in one direction. It means price moved inefficiently through that area, and traders often watch for price to return there before continuing. Premium and discount. They help you understand whether price is expensive or cheap inside a range. Above the 50% equilibrium level is premium. Below, it is a discount. In general, SMC traders prefer selling from premium and buying from discount, assuming structure supports it. Now that we understand the main terms, let's try applying this to a gold chart. The first thing we want to do is not look for an entry immediately. We want to understand the story of price from left to right. On the left side of the chart, gold is clearly bearish. Price is moving down aggressively, creating lower highs and lower lows, which tells us that sellers were in control. This is important because in SMC, we don't randomly buy just because the price has dropped a lot. We need price to reach an area of interest, take liquidity, and then show evidence that control is shifting. At the very top, we have a supply zone. This zone matters because price previously reacted from that area and sold off strongly. In simple terms, that tells us that sellers were active there. If price ever comes back into this area, we don't automatically sell, but we treat it as a high interest zone where bearish pressure could return. Below that, we have the bearish order block. This is the last area of consolidation before the strong bearish move lower. The reason this matters is because this is where the move down originated from. If price later retraces into this area, it could act as a supply area because sellers may defend that region again. Then we see price break even lower, marked as BOS down. This is important because it confirms the bearish structure. Price is not just pulling back, it is continuing lower and breaking previous lows. At this stage, the market is still bearish, and the cleaner bias would still be to respect the downside. As price continues dropping, it eventually reaches the lower green zones, which are your demand areas. These are important because they sit below the equilibrium level, meaning price is now in discount. If we are looking for possible buys, this is where buys become more logical, not at the top of the range, but lower in the range where price is cheaper. The orange line around 45.85 is the equilibrium level, or the 50% level. This separates premium and discount. Above this level, price is relatively expensive. Below this level, price is relatively cheap. So once gold drops below 45.85 and into the demand zones, we know price has entered a potential buy area. But we still need confirmation before assuming a reversal. Now look at what happens near the demand zone. Price pushes down into the lower region and takes out previous lows. This is where sell-side liquidity is likely sitting. Traders who bought earlier probably had stop losses below those lows. Breakout sellers may also enter when the price breaks down. So when price sweeps that area, it triggers stops and pulls in late sellers. This is the part that beginners usually misread. They see support break and think gold is going lower, but SMC traders ask a different question. Did price just take liquidity before reversing? After that sweep, price reacts sharply upward. That reaction is important because it shows that the breakdown did not continue cleanly. Instead, buyers stepped in from the demand area. This is the first clue that the bearish move may be weakening. Then we get the change of character. This is marked around the middle of the chart, where price begins breaking above short-term bearish structure. Before this, price was making lower highs. Once price breaks above one of those lower highs, it tells us that the character of the market may be shifting from bearish to bullish. The change of character is not guaranteed by signal. It is a warning sign that the previous bearish control is weakening. This is where traders should start paying closer attention, but not blindly enter yet. Around the change of character area, we also marked an FVG, or imbalance zone. This is important because the move that created the shift was sharp. When price moves aggressively, it can leave behind inefficient price action. That imbalance becomes a possible pullback area. If price returns to this zone and reacts, it can provide a cleaner entry than chasing the first move. After the first reaction, price does not immediately fly straight up. It moves around, pulls back, retests, and even creates another short-term bearish break on the right side, marked as BOS down. This is where context matters. If someone only looks at the BOS down alone, they may think the bearish trend is back. But the bigger picture shows price is still trading within discount and demand, not in premium. This is why SMC analysis cannot be based on one label. A BOS down inside a major demand zone does not mean the entire market is bearish again. It may simply be price taking more liquidity inside a larger reversal area. Then price taps into the bullish order block inside the lower demand zone. This area is important because it represents the base before the strong move higher. When price reacts from there, it shows buyers defending the discount area. This gives more strength to the bullish idea. From there, we see a much stronger bullish move. Price pushes up aggressively from the demand zone. This is what we call displacement. Displacement matters because it shows intent. A weak bounce can be noise, but a strong aggressive move suggests that buyers are actually stepping in with force. Then, price breaks above previous high on the right side, marked as BOS up. This is one of the clearest confirmations on the chart. Before this, the bullish idea was developing. After this break, buyers have proven that they can break structure to the upside. This gives the chart a short-term bullish narrative. Now, here's the most important trading lesson in this chart. The best entries are not usually after the big green candles. Once price is already pushing up near the current level around 45.98, you are no longer early. Price has already moved away from demand and is above equilibrium. That means buying here carries more risk because price could easily pull back after such a strong push. A cleaner trade idea would be to wait for price to return to a point of interest. The first area to watch would be the imbalance, or the FVG zone. If price pulls back into that zone and forms a bullish reaction, that could suggest continuation. A deeper pullback into the bullish order block would also be interesting because that is where buyers previously entered strongly. The demand zones are the deeper areas. If price pulls back all the way into demand zone 1 or demand zone 2 and still holds, the bullish idea may still be valid. But if price breaks through those demand zones and fails to reclaim them, then the bullish narrative becomes weak. This is where invalidation matters. If you are bullish, you need to know where your idea is wrong. On this chart, if price breaks below the lower demand region and cannot recover, then the idea that buyers are defending discount becomes much less convincing. The supply zone above is also important. If price continues upward, the next major area where sellers may appear is the upper supply zone, around 46.55 to 46.68. That would be a logical target area, or at least an area to be careful around, because it is where the previous sell-off began. Thank you for watching, and if you found this helpful, please leave a like and subscribe for more breakdowns. I'll see you in the next one.